Welcome, everybody. We are going to do a little info session on 5 programs slash options for helping your clients buy a home with 0 down payment. And we want this to be interactive and as valuable as possible. So if you have questions or if you have scenarios or if you don't understand something or anything that we covered, please let us know in the chat or the Q&A box. The recording or replay will be available immediately afterward at the same link that led you here. We've set it up that it will automatically transform into an on-demand recording for anyone that wants to do a deep dive back through it. And if you have scenarios or questions that you don't want to share publicly, certainly you can reach out to either Jordan or I directly. Jordan, I thought it might be a good place to start as we have people hopping on, and I'm sure we'll have more folks joining us. A good place to start might be reviewing the 3 pillars because they directly correlate to a lot of these programs and options that we're going to be walking through folks through.
Okay. Yeah.
Does that make sense?
Yep.
Right on.
Sorry, I just middle of someone would call me over and over.
Gotcha.
I had to turn my phone off. So I was just like, come on. I was trying to get it turned off.
So the 3 pillars. Pillar
Yeah.
1 is
Income, credits, and then assets. Okay. So anytime we're talking about 3 pillars and talking about like niche financing or financing for like for example, 0% down products,
yep.
You typically want 2 of the other pillars. Okay. And what I mean by that is traditionally, you bring a down payment with a mortgage, right? There's a down payment involved. If that down payment is missing, they're going to require the other 2 pillars, which is income and assets. Your income has to be verifiable through traditional sources, and then you have to have, credit. Sorry, income, assets, credit. So credit has to be decent. Usually a higher credit score for DPA programs in
Yep.
certain situations, as well as a income that you can verify.
So verifiable. So for any of these, we're going to need verifiable income and at least decent credit. And we'll as we go over some of the different programs and options, we'll dive deeper into what that credit requirement might look like specific to that option. Because in these scenarios, the assets we're asking for minimal assets, right? That we're this assumes that they don't or either don't have or don't want to have to put a large down payment on their purchase. So income, credit, and assets. Why don't we go ahead and start with one that we talk about this one pretty often. We talked about it on last week's info session. We'll probably even have an upcoming session where dedicated just to this one idea where we can do a deeper dive. But option 1 is FHA plus DPA. So
Yeah.
FHA financing plus down payment assistance. Go ahead, Jordan.
A lot of these products you'll notice for like down payment assistance products or grants at a state level or second lien mortgages that will cover the down payment. They're always tied with an FHA mortgage. And traditionally speaking, that's because banks make more money on FHA is really what it comes down to. Uh, and at the end of the day, they're giving this money, to you, and it ties better with FHA than it does conventional. So
Yeah.
it's rare, but they are out there. There are conventional DPAs. I think out of our 220 lenders, we might have one, and they're very difficult to qualify for compared to FHA. where we have 36 different DPAs. Not that all DPAs are created equal, right? At the
Right.
end of the day, they're not, and we'll talk about that in a second. But essentially, we're looking for an FHA product when someone is asking for money down, to help them with their either closing costs or down payment. And really how we search for our DPA. So I mentioned that we had 36. That doesn't mean that I'm going to use 36 different DPAs.
Right.
At the end of the day, I might use one or two of ours. And what I like, and the reason why is because they're broader. What I mean by that is DPA requirements for a home in California is completely different from a DPA requirement for a home in Pennsylvania.
Yeah.
Uh, it's just they're much harder to run across and find. Number one, that have the income limits that allow you to buy those homes in California, versus a home in Pennsylvania, for example. Right, the purchase prices are vastly different. So when we're talking about broad, I'm talking about the least amount of restrictions for people I could possibly find. And we have one in particular that I like, which is it's through a company called Click and Close. They offer a DPA, they're a wholesaler. They offer a DPA at 3.5% down and 5% down. This one does have to be paid back over 5 years if you sell or refinance the next 5 years. But restriction wise, there are no restrictions. You
Yeah.
don't have to be a first time home buyer. You don't have to be, the debt to income ratio requirements are higher. There's no income limits. It's not specific by area or state. You're not going to calculate a median income. And that's just one example of what I would call a broad product where I could use it in California, but I can also use it in Pennsylvania, and I can use it for someone that has a 580 credit score, for example. They also go down to a 580. They also do manual underwrites with these, which are important because a lot of DPAs you can't get the system to accept you, but if you meet the manual requirements, they'll allow you to manual underwrite it as well. So,
So on this one, Jordan, this assumes that someone is going to qualify for FHA at 3.5, right? We talked
mhm,
last week. You can qualify for FHA at 500 to 580, but at that level, it requires 10% down. So that's not going
correct.
to work for this scenario. But
No,
580 plus
it's pretty,
theoretically
it's
can
all the
qualify for
same.
three and a
Yeah,
half.
it's all the same as a regular FHA loan for this particular, product. We have other products, like I have another product where maybe we don't need the full 5% and we are in a declining market, which means that we're going to probably refinance. I have another product through EPM that's forgivable on day one, but they have requirements, first time home buyer, for example.
Yeah.
Debt to income ratios can't exceed 50%. There's a little more restrictions on it. I would say it's a better product, but uh in the terms of what the market is having for us right now, what the overall longevity for the client, so to speak, it's a better product for that reason. But it doesn't necessarily open it up to everybody, right?
Yeah.
If you've ever owned a home in the last 3 years, you know, you'd have to be over 62 years old, or they have three requirements on it, and we can do a deep dive on this one day, but basically requirements are first time home buyer, income limits, or 62 years old or above, for that particular product. But it's forgiven on day one. That's the big one. And it's national. Usually you don't find programs that are forgiven day one or after a year or after 5 years, unless it's a local grant, right?
Right.
A
Right.
local grant specific to that state and to where it's not available for anyone else. So that's a product that's nationally
Um,
given.
just just a side note here: when if and when you send us a client or a potential client, what one of the things that we will do, whether it's Jordan or Maria or Taylor or someone else on the team, they're going to ask exploratory questions to find which of the big picture products or programs might be applicable, and then also if this is the scenario, which DPA is going to make the most sense? Because Jordan mentioned one that has a wider net, let's say, has less overlays or disqualifying factors, let's say. But there are some that are better for the client that it just they may have some additional qualifying factors, but if the client meets those, it might be a better scenario. So that's one of the value propositions with our team, is that because of the number of wholesale lenders that we work with and the number of products and programs, we can go and shop and find those best scenarios for your clients, not just to get them the best deal, but in many cases, take someone from not being able to being able to qualify and purchase. Isabel asked, "What's the name of the loan that is forgivable on day one?"
It's called our Empowered program. It's through Equity Prime Mortgage. Um, so it's through their wholesale department. So it's just an FHA loan. It's really, again, it's tied with an FHA loan. So from paperwork standpoint, Isabel, you're not gonna, your offers would say FHA everything. It wouldn't be, you
Right.
wouldn't technically know what the program's called
Yep.
specifically. So
And then CB, 3 questions: How do earnest money and DPA programs work together? Number one. So the earnest money would just get credited towards whatever, just like it would in any scenario. And in some cases, it might mean that the client is getting a check back at closing.
mhm.
So
That happens a lot
you,
with VA clients as well, right?
yep,
Where it's zero down, right? We're having all of our closing costs covered. It would either
yep,
come off closing costs or, a check back essentially.
yep. Do new home builders work with DPA programs, and how? They wouldn't really, it wouldn't really matter, CB, because it's just FHA financing.
Yeah. Again,
That's
it's
it.
still listed as FHA. They're still getting them the exact amount of money they would
Yep,
for FHA. It's just the client is getting a subordinate financing or a grant to cover the down payment.
yep. And
So from the
lastly, how
builder's
quickly can
perspective,
those, what's that? Yep.
I said
And
from a builder's perspective, it doesn't change. So.
how quickly can those funds be supplied to the builder? Again, it's just like any other funding.
Mhm.
CV, they're not doing anything. They're not agreeing to anything different than what they already would with a traditional FHA offer.
Mhm.
It's all the same to them. They get their money just like any other scenario. But
Now I
great
will
questions.
I will elaborate on that a little bit. I don't think this exactly pertains to the question that you asked, but I think it's important to elaborate on. Is there's a lot of when you do local, these are national grants that we brought up. Okay, these are done at the lender level. They're not done. We don't have to reach out to anyone to get the money. Where you can slow down the mortgage process depending on what kind of DPA you're doing. Sometimes you have a grant on a state level for a specific, like if you're in Missouri, the MHDC product is you would have to reach out to them state, and it could add another 5 days to your loan process, and that's where a lot of times people get uh hey, grants are slower, it takes longer, things like that, is because
Right.
we have to reach out to a third party to get the money. The two we just brought up, you don't have to reach out to a third party at all. It's money in-house essentially.
Yep.
That's
Yep.
why they can offer it on a national level as well.
Yep. Number two, USDA loans. USDA loans. Jordan, what
So
can you share about these?
so I'm from Kansas. So if, I've done a lot of USDA loans
Yeah.
in my life. It's a great product. They have income restrictions. Okay, there are income restrictions. It's based off your household, and they take everybody in the household. Just as a quick footnote. So if your 16-year-old kid is working, it counts towards the total household income on qualifying. Usually a family of four is over 100 grand, but it's also based off area, right? So it's based off counties, things like that. And there's an eligibility map as well for what areas qualify. I
Yep.
think a lot of people are surprised on how much USDA qualifies for. I don't think a lot of people realize how big of area USDA would count for. But there's a specific eligibility map that you can just type in an address and it will just pop up and say this address is eligible. As real estate agents, you should offer this for everyone. They're a solid product, and since the new change, I want to say about a year and a half ago, they changed to the 3.4. They changed the IRLA, the loan application. USDA did a really good job on their rollout, and where they were slower in the past, they are much fast. They upgraded all their systems.
Beautiful.
So USDA loans they close just as quick as a tradition, FHA conventional financing now, where before I would used to ask for 45 days. I don't anymore.
That's a great
Um,
distinction because I remember when I had first reactivated my license back around 2020, one of the first clients that we helped was USDA. And at that point, you like if they had a lot of loans in process, you were literally just like waiting in line and waiting
yeah, it'd be like
waiting to
60,
find out
70
like when.
days. Yeah.
Yeah.
When you get
Yeah.
close. It's not like that anymore. We still check the turn times. I always check my turn times
Yeah.
before we make an offer on USDA, just so we're not you never know. You never know if they get backed up, if they get a big influx. But as far as I could tell, they upgraded all their systems and they did a really good job on the rollout, which most companies did not do a good job on a rollout.
Yeah.
So USDA loans are solid loan, 0% down. The mortgage insurance is 0.35% monthly. So that's it's a cheaper mortgage insurance than all the products besides VA. Okay. As well as the rates are going to be comparable with FHA and VA as well. So payment wise, even though it's 0% down, it's probably going to be less or the same as other products.
Yeah.
So it's going to have a more aggressive payment as well.
You can get 6% seller help.
Mm-hmm.
So there's that. I'm just kind of summarize. So you can get up to 6% seller help. It does require that the property qualify geographically, and you can just go Google USDA eligibility map. And there's a map, you pop in an address and it'll show yes or no. It basically there's a I think it's orange if it doesn't like the map coloring is orange if it doesn't qualify, if I remember correctly. From the borrower qualifying perspective, they take into account household income. Jordan, 620 plus credit score, is that right?
Yeah, but it's going to be hard to get someone approved at 620.
Okay. So what's more realistic?
640.
Okay. Okay.
Debt to
So
income
good to
ratios
know.
are, yeah, debt to income ratios are pretty stringent as well. 28%
Okay.
front end, 43% back end. They're going to be pretty tight, qualifying as well on those.
Yep. Yep.
So keep that in mind.
Okay.
It's how much house they can buy might be a little bit less.
Yep.
Okay.
Number three, VA financing.
Uh, So I know I talked about three pillars before.
Yep.
Uh, in what we kind of need for three pillars. VA really throw all that out the window. It doesn't exist for VA technically. They do have a requirement for residual income, which I'm not going to get too much into it here, but essentially, it's a how much over income, disposable income that's left over after all their bills and their monthly mortgage payment, and as long
Okay.
as that they meet that calculation, which is roughly around a 65% debt to income ratio. Okay,
Wow.
where it's high,
Yep.
way higher than any product that are out is out there. There are no credit score requirements, and there are no down payment requirements. That
Yep.
doesn't mean the system's going to say yes. Okay, it's still 0% down. Manual underwrites are something that VA probably does the most of, right? Which basically we're overriding the system saying no, and then we're running a manual underwrite. Um, but it's a great product. No mortgage insurance, 0% down. Uh, I'll give you an example. I'm going to give you an example of a client that I helped just the other day to get to get what they need to do. This client had a tax lien, $250,000 tax lien.
Wow.
They needed to cash out their property and pay that tax lien off because they didn't owe a bunch of money on their property. And we couldn't go conventional. Debt to income ratios were too high. They had too high of debt load. Just wasn't going to work. There's no product that work except for VA. At VA, we had a 63% back-in ratio, and we got an approval for it. So they had more income there that they couldn't use because they weren't quite on the job long enough. I know they were to be able to make the payment, so I wasn't too concerned about it. But that is an example of being able to help someone, to get them where they're trying to go, where on a traditional loan, it would not have worked.
It's also an example of the creative problem solving that I was alluding to a few minutes ago, which is one of the value propositions that we offer is Jordan is as good as anyone I've ever worked with on financing, at looking at the pieces of the puzzle and figuring out the best way to fit them together to take dead deals and revive them, or to make deals that don't seem like they should work. And my very first experience with Jordan, he took a dead deal and brought it back to life and saved two transaction side, listing side and buy side, because the client, um, it wasn't making sense for her financially. Jordan looked at the whole financial picture and figured out how to maneuver things so that she could make the move that she wanted. She could be her total monthly expenditures could go down below what she was even willing to do, and it saved transactions. Jordan's also proactively we had a deal in North Carolina that was multiple transaction side, that the creative problem solving, and I believe using one of the next of our five options to make a deal happen. Which number four is gifts of equity. I think we used gift of equity in that. That was the
Yeah, we did
we're in North Carolina. I
something
can't
like
remember
that.
the names of the clients right off the
Mm.
top of my head, but anyway, the option number four for helping folks purchase with no down payment is gifts of equity. And actually, Jordan, you can talk about this, but there's been some updates to the
Yeah.
flexibility on this in the last
Yeah,
three to
which
six months as well.
I think this is absolutely something that if you're struggling to sell a house, this is something that every realtor should pay attention to at the end of the day, because this could help you sell houses.
Yep.
About to tell you. So gifts of equity traditionally are done from family. If you're buying a family member's house, so let's say me and Josh is my brother. I wanted to buy his house. He could gift me the equity for the down payment and closing costs. It does not have to meet the 6% in seller concessions anymore at that point. He could gift me 50, 50, let's say 150 grand if he wanted to.
Yep.
And my closing costs would go against it. My down payment would go against it. I would bring no money out of pocket, and boom, we'd close. Typically, gifts to equity will have an arm length transaction. So FHA, it'll be about 15% down. Okay. Conventional doesn't have that, but you could only do gifts to equity previously on with family
Yep.
members as well. Where now, as long as you have no relation at all to the buyer, you can do gifts to equity. So you could offer a gifts to equity on your listing to give people the option to do 0% down. It's technically not 0% down. At the end of the day, the equity is going to come, the down payment is going to come from the seller, quote unquote.
Right, but the buyer is not bringing the down
Yeah,
payment.
the buyer
Is the
wouldn't bring the
idea
down
that we're
payment.
trying to
Yeah,
hammer home.
and it could cover all closing costs too. So where someone's limited at 3%, like maybe it's you're working a smaller state, right? Where someone's limited on 3% in seller concessions, and we need a little bit more money. You can convert it to a gift to equity now instead, and give out 5%, gift to equity. Where concessions on conventional loans is 3% for 5% down. Anything above, I think it's 10%, it goes up to 6, and then anything above like 20 is like 9% or something like that.
Yep.
I have to look exactly what it is, but essentially, sometimes on the lower loan amounts, you will run into concessions issues if you're trying to get a closing cost covered. This is one thing that would help you cover those closing costs, as well as down payments and other ways to market property, sell property, immediately. Instead of reducing that hey, we're gonna reduce our listing $10,000, offer a $10,000 in seller equity. Remove one of the pillars for someone to qualify. You have more people able to get into that home.
And the neighbors will love you for it.
Yeah.
You're selling it at a higher sales price to help maintain values. So
Yeah.
lots of ways that you can use this idea. And by the way, I meant to mention on the USDA, if you're a listing agent, right? Jordan mentioned using this as a listing agent, a strategy as a listing agent for a property that maybe you're struggling to sell. You should be checking every listing that you get if it is in a USDA qualified area. and making note of that, either in the public or agent remarks or both, of those scenarios. It just it creates an opportunity to get more uh, uh, interest and buzz on the property and create more inbound conversations for yourself and thereby better service to your seller. Number 5 is kind of a catch-all. There are lots of different uh, HELOCs, second mortgages, seller seconds, taking a loan from a 401k or related retirement account. Jordan, maybe hit on some of these ideas.
So where could a client get all their down payments? It's really anywhere that is sourceable. It's really what it come down to. Uh, I've done many home loans where someone doesn't want to bring funds to purchase a property, and we do a HELOC on their current primary residence, and they're moving to a new primary residence. We do a HELOC and transfer the money over and call it good, or a bridge loan, per se.
Yeah.
But they're going to keep the house. They're not gonna sell it. Um, second mortgages, of course, seller seconds. So I'll give you another example. A real example that's happening right now, I have under contract. I had a long-term investor friend that I do financing for. I've done many apartment complexes for her and things like that. She is buying a package of duplexes. All right. And so she didn't have quite enough money for the 25% down to do the blanket loan that she wants. So she's doing a seller carried financing of 10%. I said, why don't you offer that and see if they'd be open to it? They are open to it. And so now they're going to go under contract. Uh, that is something where someone, it's very niche or very specific situation, but it's out there and it happens. It happens on duplexes, happens on investment properties, you name it. And you can do it with traditional financing as well. So seconds don't have to be, and I'll give a personal example of what I'm doing on a home loan. I'm assuming a home loan and I put a seller second for the difference of equity, because when you're assuming a home loan, you got to buy out the equity or you got to get a second mortgage. That's another example of a seller being able to help you there. Didn't matter to him because he wanted, at the end of the day, he's going to get it paid off either way. So,
Yeah.
And then 401ks is a pretty common one. People pull all those out. They can take loans against them. You can do hard withdrawals. Typically, these are non-taxable things when they're buying a house. So a lot of people don't realize that they're not going to be taxed. Where if they try to pull their 401k out to buy a car, they're going to have like a 40% tax rate or 30% tax rate. Where there's actually clauses in there that for home purchase, especially first time purchases, that you can pull those money out with no tax hits at all. So
I think I totally forgot about this until just now. The first home that Pam and I, my wife, first home we bought, I'm pretty sure her parents took a loan on their 401k to help us with down payment. I'm pretty sure that's how we got part of it. So, am I thinking accurately that
yeah, you could do
they
that.
can do it they can do it even if it's not them directly purchasing. I mean, you can't just randomly do it, but
No,
because
there's
it was
clauses.
related.
It's if you ever read your 401k, it's pretty thick. Like if you ever
Yeah,
read it, but most of them have clauses to help home ownership in
yep,
general. For primary residences, if it's an investment property, you probably take tax hits. But
yeah,
for kids, things like that, investments overall, the home ownership is directly linked to wealth in
yeah,
the United States. So,
yeah,
of course, your 401k would want you to invest in homeowner,
yep.
homes at that point. Jeslyn asked, with HELOCs, would the seller keep their current interest rate? I get. I
Well,
want to
I think she's
reframe
just
the
on a
question.
typical HELOC, if they're getting a second or third position HELOC, whatever their primary mortgage rate is, that doesn't change. That doesn't affect that goes in a
Yeah,
position after that.
we're not touching anything that of existing financing. We're just
Exactly.
adding another loan, like an additional loan to it.
Yep. And
So
we
it
have a
wouldn't
bunch
affect
of
that.
we've got a bunch of fantastic HELOC options. I'm going to post um, a link to one of our. This is an online automated HELOC where folks can get funding in 5 days or less
Yeah.
with it.
So go ahead.
Isabel, can you explain what a HELOC is again? Jordan, why don't you take a swing at that?
So I think people get mixed up with second mortgage. They kind of group all this together. So HELOC is just a second mortgage, right? They'll
Yep.
just use the word terminology HELOC, but HELOC is actually a separate loan than a second mortgage. It's not the same thing.
Mm-hmm.
But in terminology wise, most people are talking about when they say HELOC, they just mean a second mortgage. It
Right.
could be anything. But to differentiate the two, a HELOC is a home equity line of credit. Basically, if Josh wanted to pull money in a house, let's say his house is worth 500,000, he owes 200,000, he wants 100 grand out, he can contact a company. He could say, "Hey, can I get $100,000 on this HELOC?" They'll say, "Yeah, here's your fees. Boom, boom, boom. This is how much money you want to, pull out." He pulls out the 100 grand. If he paid it down, he can pull it out again. There's a period that he can continue to do it almost like a credit card. It's like having a credit card on your house.
Yeah, exactly.
And
It's
where
like a credit card against a certain percentage of the equity of your home.
yeah. And you can pull from it multiple times over a certain year span. Some of these are 3 year, 10 year, and then they amortize over 30 years. So,
Yeah.
that you eventually have to pay it off. Now, with that being said, you also have options of just second mortgages. So second mortgages are typically cheaper, but they're called close-ended second mortgages. Hey, Josh wants to do the same thing, pulls the 100 grand out, but it's a fixed term. You're just paying it down like a normal mortgage would be. He's just going to get 100 grand at a certain interest rate. Here's your payment. It pays off over 20 years. He
And
can't
I can't
redraw
reuse
for.
it. In
You
other
can't
words,
reuse.
like I can't, if I pay down half of it, I can't reuse it. I would have to refinance again. I would have to
No.
redo it. Whereas the HELOC is open ended. It's a what's the word I'm looking for?
Line of credit.
Yeah, it's a line of credit. It's an open. It's There's another word I was trying to come up with, but my brain doesn't want to work. But it's just open ended versus closed end. A second mortgage, a fully amortized second mortgage is a closed ended mortgage. So it depends on what the equity is intended to be used for, which one makes sense. I mean, there are lots of factors involved in deciding which is the best option for the client. But we have loads of them, and we have many different HELOC and second mortgage options. We have, this is a little bit off the topic of today, but not really. We've got, you can use bank statements for them to qualify. We have them
PSCR.
available on primary, secondary, and investment properties. The combined LTV is going to vary depending on credit and if it's a primary, secondary, or investment. There are lots of factors there, but if you'd like to explore any and or all of that, you've got Jordan and our contact information on the screen here. You can call, text, or email either of us. We try to be extremely responsive and get back to folks very quickly. If you have clients and you would like, or a scenario that you would like us to explore, one of the things that we do is we can set up co-branded application links. And Jordan, if you can read and address CB's
Yeah.
question, I'm going to bring up an example of what the co-branded links look like and let people know how they can get
So
one of
she
them.
said, so if an individual has money in the bank and enough to cover a down payment, could the individual still get a DPA because they don't want to move into a house and have no money, save money? Yeah, this is pretty common. So yes, the answer would be yes. Now, traditionally speaking, just so we'd advise them, it cost them a lot more money on the long run to do that versus spending all their money just taking a loan after closing or something like that. It's there's ways that we can work around to get them what they need and to get them the best financing possible, like thinking creatively. But yes, theoretically it is possible, but I wouldn't necessarily recommend it because the interest rate for if they have the money to cover, might as well do that and figure out a different option versus going straight to DPA because DPAs cost more, right? There's less skin in the game, has a higher interest rate, and typically your house is the highest loan amount that you're going to have. You're not going to have any other financing that has a bigger bigger payment and slash money, owed.
Yep. So we use a platform that makes it's just a very user-friendly interface and makes it easy to get folks engaging and applying. And this is an example of a co-branded app. And Mike on my team just built this one out right before we went live here. If you'd like something like this so that you can very easily and seamlessly start referring clients, you can just reach out to myself, or you can even email Mike directly at mike@growwithjosh.com. Mike@growwithjosh.com. He will make these for you. He'll give you the long, ugly version of the link and even give you some shortened versions that make it easier to text or email a client, or even just give it to them if you're at an open house with someone and they need that. You can, just make it as easy as possible for them to get started with the process. How much more typically would a DPA cost someone above the stated FHA rate? So two different things. You'd have the fixed rate on the FHA, 96.5%, right? That wouldn't. They're two separate things.
So they're two separate things that can, on mortgage, there's going to be two separate things that are costs: closing costs, down payment, right? Typically, or I guess closing costs and rate, really, more than anything, because it's relative to each other. Because I always like to use the example, and I'm not going to try to drone on with this, but I think this is relative. Interest rates all relative to how much money you want to pay or how much money you want to get back. Okay. So I have an example I always like to use is there's Jack, Jill, Jim, all of them getting the same rate. What's the difference? Well, they have different, maybe, the one's getting 4%, 5%, 6%. What's the difference? The difference is one's probably wanting to buy down the rate. One's probably wanting to get more money back, right? At the end of the day, if they're in the exact, same scenario. Now, with that being said, you're already getting money back on a DPA, so it's going to have a higher interest rate. I would say the biggest difference, they usually have what I like to call a set rate for everyone. It doesn't matter if you're an 800 credit score or it doesn't matter if you're a 500 credit score. They're giving you X rate. It's just whatever that cost would be on closing costs. So I would say on average, to answer your question, usually it's about 1% higher and at least 1 to 2 points more in closing costs. Okay. We try and avoid extra closing costs because we're just basically, robbing Peter to pay Paul in that example. Because it puts harder on you trying to get seller concessions if the concessions are needed that are higher. So ideally speaking, we want something that doesn't have additional closing costs. And so we take a higher rate, especially in this market where we're trying to refinance. But traditionally speaking, I would say 1% higher on rate. That was a long explanation to get there, but it's complicated because they're all different.
And this is, I don't know, at least interesting on some level. Like a client can really get whatever rate they want. It's a matter of what are they going to pay for it, and finding the happy medium between.
I want to make clear. I locked someone in at a 3.875, not even 4 months ago. So I did that, but they also paid $13,000 on a $150,000 house to do it. It was very expensive, right? They got seller concessions, but still very expensive.
Yep. Jesslyn asked to post Mike's email, so I posted it there. It's mike@growwithjosh.com. mike@growwithjosh.com. It is also posted in the chat. Bally asks, how about DSCR loans? What about them, Bally? We have, and in fact, I need to, one of these Tuesdays, I'm going to have Taylor on our team come on to talk about DSCR loans. We have several past sessions, info sessions like these that we've done on DSCR loans and options, but we have lots of them. You're not going to be able to do a zero a no money down on a DSCR loan, but we've got great options and products and programs for them. And we'd love to explore those with you. And if you're open to it, I'd love to connect you with Taylor on our team, who is our DSCR loan specialist. He's got many, many years experience on these types of loans. DSCR has just more recently become a popular acronym, but on non-owner occupied investor, hard money, fix and flip, he's been doing that for years and years. And he's been a great addition to the team, thanks to Jordan bringing him on board. Mm-hmm. And if there's a specific question you have, Bally, right now, feel free to drop it below as well. But we literally have, I mean, I get many emails every day from lenders that we have relationships with about their DSCR loan programs. I mean, that we literally have everything under the sun when it comes to that. And if we don't have it, we can go and find it and bring that lender on board as well, within reason. Again, I mean, that you're not going to. There are ways that we can creatively do deals with quote unquote no down payment, using in particular option number 5, right? Maybe looking at how can we pull equity from somewhere else and get, creative with maybe a seller second, things of that nature. But there's going to have to be, on those types of deals, there's going to have to, there's some way to address the 15 to 25% down necessary for those. Well, I think we're good. Some housekeeping items. Number 1, once again, the recording, the replay of this will be available immediately afterwards on demand. We also always take these recordings and add them to the Wake Up Real Estate YouTube channel, Wake Up Real Estate YouTube channel. We also put them on our podcast feed and at wakeup.realestate. Make it as easy as possible for you to find those and go back through. And if you would like a co-branded application link, just email mike@growwithjosh.com or reach out to me. I'd be happy to get that squared away for you. And we'll be back next week with another mortgage info session to help educate you so you can help more clients and borrowers, and maybe we'll have the chance to help them as well. Thanks for the kind words, Bally. Jordan, thanks for your time and expertise. And hopefully we'll see everybody next week.
Sounds good. Appreciate it.
Thanks.